Hello there, Prof. Aram here, and in this video we're going to focus on the two types of leverage. One is the operating leverage, the other one is financial leverage. This operating leverage can be correspondent to business risk of the firm, and the financial leverage, we're going to relate it to financial risk of the firm. So let's get to this. Business risk is the uncertainty in the earnings of the company. And this uncertainty can be about demand or the number of units you're selling, uncertainty about the output prices, input costs, about the products that you're selling, the types of the liabilities that you have, or overall the degree of operating leverage. In other words, business risk is a risk that a firm's common shareholders would face if firm was financed with all equity. There was no debt. So it was just your shareholders' money, and that's it. There is no debt in the capital structure. So that's the risk of the business. The shareholders are going to bear all of the risk of this business. This is the risk inherent in the firm's operations. So what is this operating leverage and how does this affect the firm's business risk? If you think about it, sometimes your business is doing good, so you will have high earnings. Other times, for example, during recessions, businesses will suffer and earnings will go down. What matters here is your fixed costs. If your fixed costs are very high, then you're going to face greater risk, greater business risk, especially in a slowdown. So basically, operating leverage is a change in earnings caused by a change in quantity sold. So the higher the proportion of the fixed cost relative to the variable cost, the greater the operating leverage. So if, for example, you have your sales minus cost of goods sold, that gives you your EBIT earnings before interest and taxes. So keep in mind, this cost of goods sold has two components. One of them is the fixed cost, and the other one is the variable cost. So if you sell fewer units, your variable cost will go down, but your fixed cost is fixed by nature. So if you have very high fixed cost, then you have high operating leverage and high business risk. You can find the break-even quantity. The quantity that you find here is basically your EBIT equals price times quantity sold, which is your sales, minus variable cost minus fixed cost. All of them should be 0. So that means your break-even quantity is going to be your fixed cost over price minus variable cost. Let's look at an example here. Let's say we have two companies. One of them has a fixed cost of $20, price per unit is $2, and the variable cost is $1.50 per unit. The other one has a very high fixed cost of $60. Since they're selling the same thing, the price is going to be $2 and the variable cost is going to be $1. So the variable cost is lower than the variable cost of the first case, but this is the part that we worry about, the fixed cost of the company. This company, the one with the lower fixed cost, has to sell 40 units to break even. But the other one with a high fixed cost is going to have to sell 60 units to break even. That means that this company with a high fixed cost has higher degree of operating leverage or higher business risk. The higher the fixed cost, the higher the business risk, the higher the degree of operating leverage. So, what is the effect of leverage here? All of the business risk must be borne by the firm's owners if the firm is all equity. So if, like in this case, we have an all equity firm, meaning that the capital that was needed to purchase the assets were provided by the equity holders of the firm. So all the business risk in this case has to be borne by the firm's owners or the shareholders. Let's assume that we have 4 units of risk per shareholder here. All the business risk in this case is being borne by the shareholders of the company. But what about a firm that is partially financed with debt? Meaning that what happens if we borrow money enough to buy the shares of this equity holder, this shareholder, and restructure our capital structure? Now we are changing the structure of our right-hand side of the balance sheet. Before it was 100% equity. Now it's going to be 20% debt and 80% equity. Now, what about this case? What happens to business risk? The equity holders still bear all the risk because they are the residual claimants of the company. Keep in mind, debt is the safest security a firm can offer investors because lenders bear little or no business risk. They are going to get paid their interest and principal no matter how the firm is doing. So if the lenders don't bear it, then equity holders must bear it. So what happens here is that these guys, the equity holders, have their original amount of business risk, which was 4 units each. But now these units of risk is going to be spread out to the remaining shareholders of the company. In other words, this additional risk that the shareholders of the company are accepting is related to financing, is because of the financing choices that they've made, because they borrowed money. So the extra unit of risk here is a financial risk that is added to their base amount of risk. Again, now there is less equity because part of the financing is replaced by debt in the capital structure. But again, the amount of risk per dollar of equity must rise as the firm introduces debt. So the total amount of capital is the same. So the total amount of business risk is the same. But the risk now is reallocated, meaning that they moved from all equity. So these 4 units, now it's reallocated to the remaining shareholders of the firm. Each shareholder now bears an additional unit of risk because of leverage. And keep in mind, the more safe debt the firm decides to issue, the riskier the remaining equity will become. In other words, if we change this to debt as well, now these 5 units have to be spread out among the 3 other shareholders. We saw that equity is riskier than debt, and leverage amplifies business risk from the perspective of the equity holders. So this should matter. Investors certainly care about risk, but how? Let's look at an example here. Here we have two scenarios. One is all equity. Currently, the firm has 8 million in assets, 0 debt, and 8 million in equity. So of course, the debt to equity ratio would be 0 over 8 million, which is going to be 0. There are 400 shares outstanding. So the price per share is going to be 8 million over 400, which is going to be 20. And the proposed capital structure is going to have 50% debt and 50% equity. So this $8 million in assets is going to be financed by 4 million in debt and 4 million in equity. The debt to equity ratio is going to be 1 here. In the proposed capital structure, you still have $8 million in assets, but now you have 4 million in debt and 4 million in equity. In other words, you're going to borrow $4 million and repurchase half of the shares of the company. So the shares will go down to $4 million. So 400,000 shares outstanding is going to be 200,000 now. The price per share is still $20 because you're dividing this 4 million equity by a smaller number of shares, so it's going to stay the same. So the question is, how do shareholders care? Of course, shareholders care about the increased risk because of borrowing money, but how? Here, we're looking at 3 states of economy: a recession, expected, and expansion. So for the expected section, your earnings are 1 million, 0 debt, so your net income is going to be 1 million. So 1 million divided by 8 million in equity, you will have 12.5%. But when you introduce debt to the capital structure with 10% interest, so 4 million times 10% is going to give you 400,000 in interest. You need to pay that interest, which lowers your net income. But shareholders are fine with that because now there are fewer shares outstanding. So this 600,000 is going to be divided by 4 million, which is going to be 15%. As you can see, leverage increases your return and increases the earnings per share. And keep in mind that regardless of how the economy is doing, the interest is going to be 400,000. Interest is fixed. When you borrow money, in effect, you're increasing the fixed costs of the business as well. That's why the risk is increasing. Keep in mind, this $1 million, the initial $1 million here in EBIT has been levered by debt in the firm leverage capital structure. That means that the increase in the ROE and earnings per share that you see here from 12.5 to 15 or from 2.5 to 3, this increase is solely because that the firm used debt, the firm used leverage. And of course, shareholders are happy in expected or expansion cases. So if you have no debt in a boom economy, your ROE is 18.75. But if you do have debt, it will go up to 27.5. So it will magnify your returns if you have debt. But the leverage amplifies the pain of poor results as well, meaning that in this case, when you have a recession, when you have 0 debt, your ROE is 6.25. But when you introduce debt because of this fixed cost of debt, your ROE goes down to 2.5%. So leverage has 2 sides. One is, of course, when the economy is doing well, when the firm is doing well, it will magnify the returns. But when the economy is in a recession or when your company is doing poorly, it can magnify the pains of losses as well. Leverage increases the variability in both ROE and earnings per share when you use debt. And To find the break-even point here, you need to find the earnings per share of no debt with earnings per share when you have debt. And in this case, we see that EBIT over 400,000 shares and EBIT minus the interest over 200,000 shares. If you do this, you see that the break-even earnings is $800,000, or the break-even earnings per share is $2. In other words, what we're doing here is we're finding the EBIT where the earnings per share is the same under both current and proposed capital structures. So basically this one, 800,000. So we're finding the EBIT that earnings per share is the same under both scenarios, the current all equity and then the proposed 50% debt, 50% equity capital structure. If we expect the EBIT or earnings to be greater than the break-even point, then leverage may be beneficial to our shareholders. In other words, if expect that the EBIT is going that side to the right, of course, there is advantage to debt because given the earnings that is higher than the break-even point, the levered position offers a higher earnings per share compared to the current situation. And if we expect the earnings to be less than the break-even point, then leverage is detrimental to our stockholders. So the effect of leverage depends on earnings. When earnings are higher, the leverage is beneficial. Under the expected scenario, leverage increases the ROE and earnings per share, but shareholders are exposed to more risk with more leverage. ROE and earnings per share are more sensitive to changes in the earnings for the company. I hope you find this video useful and thanks for watching.